I know that you came out of retirement just to join me on the topic of yield curve control. So thank you, as always. Walk us through, what does yield curve control look like to you?
Well, as Scarlett Fu mentioned earlier, before the break, the Treasury and the Fed had agreed in the early 1950s that the Fed would not be targeting interest rates as a way of financing economic activity. And basically, I would say there are two fundamental problems, and I, of course, am opposed to the yield curve control approach. There are two fundamental problems. One, the yield curve provides information. It provides information in terms of what is the opportunity cost for an investor today as opposed to buying a 3-month or 2-year Treasury note to buy a 5 or 10-year. That's important information. And the second part is the future is uncertain, as Yogi Berra said. And so you need to compensate people for the risk of either buying the bonds or investing in the bonds over time. There's a risk of higher or lower inflation, differences in economic growth, and as we saw with sovereign bond yields a few years ago in Europe, there's a certain sovereign risk with respect to those rates. So I am opposed to the yield curve control. I don't like the idea of the Fed dictating what those interest rates are going to be, because those interest rates are probably very unlikely to be consistent with the opportunity costs for investors going forward.
So some of that opportunity cost, if I'm understanding you, is cost of capital. In my studies, it was little k. What does that do if you're inflating or underinflating or controlling that cost of capital? And then what does that mean for future investment?
That's a very good point, Taylor, because right now the concept is the Fed's going to keep interest rates low. Okay, so the 2-year, the 5-year, maybe even the 10-year are kept low relative to some whatever benchmark is you want to consider. Well, the issue then is that a lot of investment may in fact happen now, but you're bringing forward that investment and you're not properly discounting what the opportunity costs are or the risk going forward 3 to 5 or 10 years out. So the problem is, yes, okay, fine. It's a little bit of a stimulus right now to keep interest rates low, but those low interest rates don't really reflect the real cost of capital over time.
Going out on the long end of the curve, you mentioned if you're controlling and not letting the markets dictate future opportunities for growth, inflation expectations, often which we look at by looking out on the long end of the curve. If the Fed is manipulating that to some extent, how does the market then view what could be future inflation expectations?
Yeah, indeed. Let's say the Fed were to keep interest rates, quote, low, then one would think that a Fed that is trying to or attempting to reflate the economy and get back to, let's say, an inflation target of 2.25%, then you know that, let's say they target the 10-year Treasury at 0.7%. Well, that means your real return on 10-year Treasuries are negative going forward. That's going to really incent a lot of people not to be buying those Treasuries. And in fact, by default, the Fed could be buying even more of those Treasuries in an attempt to keep the interest rates arbitrarily low. I think it's a very dangerous situation.
Shifting gears just a little bit, tomorrow is Jobs Day. What is the single most important data point that you're looking at tomorrow?
Yeah, I think for most investors, what you really want to see is the employment population ratio. Is that employment as a share of the population starting to move up? Yes, the number of people unemployed will be significant, but the unemployment rate is a lagging economic indicator. I want to see where we are in terms of employing people going forward. I would look at the employment population ratio.
And as you take a look at all of those dynamics as we approach tomorrow, as we approach next week, you had mentioned a 10-year at, what, 70 basis points. What is fair value for a 10-year or 30-year at this moment?
Yeah, for me, I like the idea that, as you mentioned earlier, that the 10-year rates are actually moving up. That's a very, very positive sign that there are expectations, once again with the yield curve, that growth and inflation will be picking up in the future. For me, looking at what I think the 10-year might be in 6 months to a year, I think 1.5% to 2% is a reasonable number.